Good morning. This is Dr. Ali. Today is July 5th, and I'm sorry for the delay for the last 15 minutes. We are still going with the long-term liabilities, particularly the bonds, and today I will be talking about the accounting for the issuance of bonds. So I'm going to go by the textbook. So please go to page 551, and we're going to look at the accounting for bonds under different circumstances. When the bonds are issued at face value, and when the bonds are issued at a discount, and when the bonds are issued at a premium. All right. So when a bond is issued, I'm on page 551. When the bonds are issued at face value, that means the price of the bond is equal to the face value of the bond. So when you go and buy a bond certificate, you will pay for it exactly as the face value. That means the market interest rate is equal to the stated or the contractual interest rate. So on the bottom of page 551, you look at this example. Carrot Corporation issues 200,000 of 7% 5-year bond on January 1st, 2014, and sells them on the same date for their face value. The bond indenture states that the interest is to be paid on January 1st and July 1st of each year. That means the bonds are issued at 100% twice, and the interest is payable twice annually. So the journal entry to record this transaction is, let me go back to Word, maybe you can see that. All right, if we look at that, so we're going to debit the cash. Of course, when we are issuing bonds, we are selling it and we are collecting cash. So we're going to debit cash for $200,000. $200,000. And we're going to credit bonds payable. Bonds payable for $200,000, and that is because the market interest rate is equal to the stated interest rate, or the bonds are issued at 100% of the face value. Now the interest expense on a member. Remember that when we issue bonds, we have to pay interest. And interest expense on this, on January 1st, okay, the bonds were issued on January 1st, 2014. So on January 1st, the payment of, if it's issued on January 1st, there will be no interest, but after 6 months, the interest will be, which would be on July 1st. So on July 1st, the interest payment is going to be, usually we're going to debit interest expense, and we are going to credit cash, since this is a payment. interest expense on bonds payable. On bonds payable. Hi. I'm just recording that thing. Yeah. On bonds payable. And we're going to credit cash. Cash for the amount of interest, which is going to be, if you all remember, the interest is equal to the principal times interest rate times time. Times time. In this case, the principal is $200,000. $200,000 times the interest rate is 7%. 7% times 6/12. Times 6/12, because the interest is payable semi-annually, and that should give us about $7,000. So we go back to interest expense on bonds payable is, or you could say, let me put it in a better way, bond interest expense, and remove the word bonds payable. Bond interest expense and the amount is $7,000, and the 7,000, and the amount of cash to be paid is $7,000. All right. That is on July 1st. Here we go. Bonds interest expense $7,000 and cash credit for $7,000. Okay. If the bond is the next issue is, and then you will make a same journal entry every 6 months until the for 10 times. You do it for 10 times. Since the bond is a 5-year bond, you will have to do it for 10 times, 5 every 6 months. So there are 10 periods. Okay. The next issue is bond is issued at a discount. Okay, let me go to the different bond issued at discount. Okay, let me bold that. And underline it. Come on in.
Morning.
Good morning. Good morning. I started about 15 minutes late, so I began recording the lecture. So if somebody misses it, so he will be able to find it. Yeah. And I'm going by the book, and I'm on page 552, and let me put the book over here. All right, we are on the second area. When bonds are issued at a discount, that means the bond value is less than the face value, and that means the market interest rate is higher than the stated interest rate. If you go back to last 2 or 3 lectures, you will find that out. Okay. So with the Carat, let's go with this. Carat issues 200,000 of 7% 5-year bond at 95.944. 95 point, what does that mean? A bond is issued at 95.944. 45. That means the bond is issued at 95.9% of the face value. Okay, if the face value is $200,000, that means the amount of cash that the corporation is getting for this bond is going to be 200,000 times. Okay. It's going to be
This is 200,000 of 7%
times 95 point what?
95.9445.
94.
95.9.
Okay, let's assume just point. Let's say 96. All right.
Okay.
To the nearest 96% times 96%. That means 96% of the face value of the 200,000. Okay, that means they are getting money, they are getting cash less than the face value. And the reason for that is because the market interest rate is higher than the stated interest rate. So in this case, okay, that's equal to, let me see if I can get my calculator here. All right, I got 200,000 times 0.96, and that gives us 192,000. $192,000 so for the 200,000 they are getting only $192,000. All right, now the journal entry to record that, we're going to debit cash because we're getting cash for 192,000. Now let me, before we go any further, let me give you a generic form of journal entries. Okay, before we go further, I'll come back to this in just a second. So let me, whenever an issue, whenever a bond is like we did with the stocks, okay, we issue stocks, we get cash.
Yes, sir.
The same thing with bonds, we issue bonds, we get cash. So if we issue bonds at discount, bonds issued at discount, okay, let me bold this one. These are the generic form of journal entries. You bold it, and okay, so we're going to debit cash, okay, for whatever the amount is, and we also going to debit unamortized bond discount. Unamortized bond discount. Okay, and we're going to credit bonds payable. Bonds payable, and I had the let me make it uniform. Bonds payable. All right. So that's if a bond is issued at a discount, you have to debit the cash and you have to credit unamortized bond discount and credit bonds payable. All right. If a bond is issued at premium, bond and bonds issued at premium, that means the market interest rate is lower than the stated interest rate. Okay, in this case we're going to debit cash as usual because we're getting cash, we're raising funds, cash. Oops. Of course the cash is going to be now larger than the stated interest rate, and we're going to credit unamortized bond premium, unamortized bond premium, and we're also going to credit bonds payable. All right. Okay. You have your book?
Yes, sir.
Yeah. We are on page page 552, but I'm writing the generic journal entries.
Generic journal entry.
Yeah, we're doing the accounting for bonds. When we issue bonds at a discount, we're going to debit cash, credit unamortized bond discount, and credit bonds payable. When a bond is issued at a premium, we debit cash, we credit unamortized bond premium and bonds payable.
Oh,
Those
okay.
are the generic entry, journal entries, all right?
You said 552?
Yeah.
Okay.
Oh, this one is payable, not oil. Sorry. Payable. All right, so these are the okay. If the bonds is issued at face value, that means the market interest rate is equal to the stated interest rate. Bonds issued at face value. All right, then we're going to debit cash, like with the stocks, if you remember. Okay, because we are collecting cash, we're raising capital. We debit cash, and we credit bonds payable. So these are the situations. All right, bond issued at, since you just came in, these are the generic forms of journal entries for accounting. At a discount, you're going to debit cash, debit unamortized bond discount, credit bonds payable, and bonds issued at premium. That means we collecting cash more than the face value, and we debit cash. Notice in all the situations we debit cash. Okay, you can see. Now we go back to the example. We go back to the example. We just did a bond issued at, what did we do? Okay. All right. We did bonds issued at face value. Okay, page 551. We did the 551, and Now we're going to do continue on page 552 on the bottom of the page. You see, bond issued at a discount. So Carrot issues 200,000, 7%, 5-year bond at 95.9%. But we said we did it to the nearest one, nearest number. So we said 96. That means 96%. Okay. That means we're getting cash. We're getting 96% of the face value. 96% of the face value, less than the face value. So this is bond issued at discount. So go back to the bond issued at a discount. We're going to debit cash. We're going to credit bonds payable. The bonds payable is going to be for the whole amount. But we're going to put the amount of cash we're getting debited, and we debit the unamortized bond. What does that mean, unamortized bond discount or unamortized bond premium? The difference between the face value and the amount of cash we're getting. So what does that mean, unamortized? We're going to amortize it later. See, the amount of liability in this case is the whole face value, okay? And we are getting less than...
So that's just the difference between the cash you get and how much
Yes,
you run.
this is treated as an expense.
Okay.
So we have to pay that expense. As we pay it, that means we are amortizing it.
Okay.
So you pay it until you pay the whole discount. Okay, whatever the difference is, you pay a portion of it. Okay, is it treated as an expense?
How often?
Is a payment of it affects our interest expense.
How often do you pay it?
It depends on the as we're gonna see in a minute. Yeah.
Okay.
How often you pay the interest? Maybe semi-annually or annually. Yeah. Okay, so let's look at the page, bottom of page 552. Bonds issued at a discount. And then we said Carrot issues 200,000 of 7% 5-year bonds at 95.9. So we just said 0.96%. That means 96% of the face value. So we multiplied the 96% by 200,000, and we came up with 192,000. Okay, so we're going to debit cash for 192,000, and we're going to credit bonds payable for how much?
200,000.
Yes, bonds payable for $200,000. So the difference is what?
8,000.
8,000. And what do we call that?
The unamortized bond discount.
Yes, sir. Debit unamortized bond discount. And the reason why we call it unamortized, because this is just the beginning of it. As of today, we have a total difference between the face value and the issue price of $8,000, all right? And that is treated as an expense, and it has to be paid. It has an effect on our interest expense. Okay, it's going to make our interest expense probably a little bit higher. Yeah. Let me make it here, and 8,000. Make it here and have the 200,000 like that. All right. Okay. This is the issue of bond at a discount, and then now we need to do the issue of bonds at premium on the next page, on page 554. And when a bond is issued at premium, that means the market interest rate is smaller than the stated interest rate. You remember those rules that we did last time? That's what it means. That means we're getting money, we're selling the bonds for over the not for over the face value.
Oh, the face value.
Yeah, I could say the market value is more than the
Oh.
face value. Yeah. All right. So with the same example, probably the transaction says Carrot issues 200,000 of 7% 5-year bonds for. This time they are issuing it for 208,000.
530.
Yeah, so we have an additional 8,530. Okay, above the 200,000. Okay, so if you look over here on our original generic entry, when a bond is issued a premium, we're going to debit cash, and we're going to credit unamortized bond premium, and credit bonds payable. All right, so in this case, we're going to debit cash for now bonds issued at premium. Let me write the title here. Bonds issued at premium. All right, and we're going to debit cash for how much? The amount of cash is
200,000.
208,530. 208,530 dollars.
Oh, okay. I thought it was
Yeah.
Okay, that's what you're talking about.
What if we says it was issued at 101 alone? That means 101%. So we would have to multiply 101% by the 200,000.
Okay.
Yeah, but this is not giving us a percentage like the first one. It's just telling us how much it was sold for.
Oh, okay.
Yeah.
So I get exactly what you're saying.
So again, we're going to credit unamortized bond premium for how much? 8,530. And we also credit bonds payable for $200,000. All right, this is the general entry for recording a bond issued at a premium. Now, if you remember last time that we talked about, we did this is easier to figure out the issue price because it's only giving us a percentage, so we don't have to go to the tables or, yeah. But now we're going to learn it also have to do it using the tables. We have to. Either way, we're going to look at the next section, using present value to value a bond, which is page 555. While you are looking that, let me go and get some water.
Seen no step kids ain't having no class. You know what I'm saying? I ain't seen no step kids around here to get. You like to work a full shift if they ain't having no class. I never. Just paid my rent today.
All right. So let's look at the example on the next page, page 556. A bond has a face value of $20,000. Okay, you see that? The example there. A bond has a face value of 20,000 and pays fixed interest of 900 every 6 months. So that's a 9% annual rate. So this is the stated interest rate. All right. The bond is due in 5 years. That means we have a 10-year. If because the payment is every 6 months.
So semi-annually.
So it's semi-annual for. So it is a 10 times 10
10 years.
10 payments of interest. Yeah, it's a 5-year, twice a year payment of interest.
So 10 payments.
Yeah, 10 payments. So the bond is due in 5 years. If the market interest rate is 12%, all right, the stated interest rate is 9%. The market interest rate is 12%. Do you think this bond is going to be issued at a premium or discount?
Discount.
Go back to the rule. Yeah, say that again.
Discount.
How? Why do you say discount?
Because the market value is higher than your stated discount value, basically. So you're gonna have to sell your bond at discount.
Yes, sir. You're right. Good. Very good.
Right?
So,
You paying attention now?
so how much do you think we're going to get for this bond? Don't look at the book.
Oh no, I didn't look at the book. I was thinking,
Remember, we need to find two present values.
yeah, the present value of the principal and the present value of the interest.
Interest. Very good. All right. Using the tables. So the interest in this case is how much?
9%.
Which is
Oh.
$900 every 6 months.
Yeah.
So how did they figure that out?
You multiplied it.
So if you do, let's do that.
20,000 times 9%.
20,000. Now wait a minute. Times interest rate times time. All right. 20,000 times 9% times 6 over 12. How much is that? Do that. 20,000 times 9% times 6 over 12.
20,000 times 6.
Over 12.
900.
900. All right. So let's find the first. Let's do the interest rate of the principal, which is the $20,000. What is the factor using the book? I mean, using the tables. Look in the back of the and tell me which table that we should look at. Which table we should look at. Let's see if I can find it before you. I found it before you. Is page 1150.
Okay, present value of $1 received at the end of a given number of time periods. So yeah.
Which table we should use for the 20,000?
Table 1.
Table 1. Very good. So we look at what percent?
9% for 10 periods. Yeah, that's
No. 9% is the annual one. You got to look at half of that.
oh, so 4. What? That's half of 9 is 4.
Yes, sir. 4.5.
4.5.
Do we have 4.5?
No, sir.
We don't. Therefore, it's a 10 periods, correct? So look at the 10. 10 periods and go horizontally until you get to the. So do the 4 and the 5, add them and divide by 2.
Okay.
Add them and divide by 2. 676 plus 0.
614
Add those and divide by 2.
equals 1.29 divided by 2 equals 0.645.
All right. That one times the 20,000. What do you get?
That times 20,000. 12,900.
12,900. Okay. Why did they use 558 in the book? 0.558 from table 1 appendix B.
That's because that's the 6% for it. Do you round it up to percentages or something?
No, I think ours is that's what we're supposed to do, like what we did, yeah.
Oh.
So let's do it that way, what we did. Since it's not clearly stated, all right? If it's not there, so we're going to do, in this case, so we're going to say 20,000 times, how much did we get?
0.645.
645, yes sir. And that's equal?
12,900.
12,900. And that's, okay. And then we're going to do the present value of the interest, which is 900. 900 times, which table we're going to use this time?
The second one, table 2.
Okay, we do the same thing since we don't have the exact interest rate, so we add the two factors and divide by 2. And we get what?
We got 8.111 plus 7.722 equals 15.833 divided by 2.
2, we get
7.9165.
7.9165, and that gives us
Times 900 equals 7,124.85.
okay. 0.25. Let's say 0.25. Or 7,125. Now add the two of the present value of the lump sum, the 20,000, the present value of the annuity. What do we call it? Annuity.
Okay. You get an annual.
So if you add the two, what do we get?
20,025.
What?
$20,025.
Now the market interest rate. Here is our problem. That's my fault. We use the market interest rate for the tables, not the stated interest rate.
Oh, see,
Yeah, that's my fault. I apologize for that. It's my fault. Yeah, we use the market value, and the market value is what?
12%.
12%. Then we should. That's why they use the 6%. So they were right. Yeah, it's my fault. But that's a lesson to us. If you don't have the exact one, that's what you do. Okay, so
I don't think they would make it that difficult for us because they had the table there. They wouldn't make you make a whole new.
so what is the for the 20,000? 10 periods, and what's the market interest rate?
6 is
12, and half of it is 6. So we have 6.
So it's 20,000 times
20,000 times
0.558.
yes, 0.558.
It's 11,160.
Okay, 11,160.
160.
And for the interest, for the
Let me see what's that for 6. 900 times
7.360,
which equals 6,624.
6,624.
Yes, sir.
All right. So add the two. What do we get?
17,780.
That makes sense. 17,784.
784.
What made me suspect?
What?
What made me suspect that we were wrong? I was wrong, not you.
Because we had to find a different amount that wasn't on the table.
Because it's issued at a discount.
And it was over.
So therefore we're getting less than the market rate is more than the stated interest rate.
So you have to
Therefore
sell
the
your
bond
bond
is
at
issued at
a
discount.
And it was over the 20,000.
Yes, sir. So that doesn't make sense, yeah.
Yeah, that would make it a premium instead. So, but it wasn't.
So we use the market interest rate for the tables, yeah. All right? Okay. That is when a bond is issued at a discount. Now we now when a bond is issued at premium now. The second one on the see that market rate below face rate on page same page 556. Okay, so it says, suppose the market interest rate on the bond described above falls to 8%. So instead of 12%, it's 8%. Therefore, we're going to multiply the 20,000 by how much?
By 4%, because it's
Yes.
semi-annually.
So we're going to say 20,000 times table 1,
Yeah, 20,000, 4%, 10, that's 0.676.
676, and that's equal to
13,520.
13,520. And for the interest, 900 times table 2. Same thing, 4% and 10 periods.
Yeah, 900 times 8.111.
And that's equal
7,299.9. So we put
7,000?
7,300.
7,300?
Yeah, that's what it round up to.
Okay.
This is the number for it right here. Is all 9.
Yes, sir. Okay, good. Therefore, we're getting 20,600. We're getting 20,820, correct?
Yes, sir.
At the 2. So we have an extra amount. We call it premium above the. Okay.
Amortized premium, which is 820.
Yes, sir. Now we're going to come to the amortization of the discount and premium. We have to learn that, yeah. Okay, so I'm going to write down here a big title: amortization of bond premium and discount. Okay. Let's start with the discount. Now again, discount means the cash value that we're getting out of issuing the bond is less than the face value. Therefore, this discount is going to affect our interest. Okay, so every time we pay interest, we amortize a little bit of that premium. We will see by how much. Okay, every time we pay a portion, we pay interest, a little bit of that premium will go, that discount will go down. And then until we amortize the whole discount or premium. All right? Okay, so let's look at an example. How do we do that? Before we do that, there are two methods of amortization. Two methods of amortization. You have the straight line method and the effective interest rate method. Okay, straight line method and effective interest method. So we have two methods of amortization. One is straight line. I'll just put SL for straight line. And the second one is effective interest method. Number 2, effective interest method. Okay? Alright, so let's look at examples. On page 558, and I'm using the textbook here, textbook examples, so make it a little bit easier. While we are doing that, I have chapter 13 assignments. I'll give each of you a, it's already posted on Jakes, so do this here and then do it on Jakes, okay, and submit it.
Yes, sir.
Okay, let's go back to page 558. Straight line method, you see that? Using the Carrot Corporation example, the one we were just doing, the interest payment dates of the bonds issues are January 1st and July 1st of each year, and the bonds mature in 5 years. Now the original journal entry was we debited, if you go back to here, we debited cash at 192,000 and we credited the unamortized bond discount to 8,000. All right. Now, since it's a straight line, okay, we divide the unamortized bond discount by 10 times.
Oh, that's how many payments you're making.
Yes, that's how much we should amortize out of this unamortized discount. Okay, so once you amortize a little portion, then the balance go down. The balance go down until you amortize the whole amount. But what happens to the carrying value of at this time, okay, when it was issued first, as you see, the cash is the carrying value of the bond, or the book value. You could say the book value or the carrying value of the bond when it was issued, 192,000. We're supposed to pay the whole
200,000.
Yeah. So the portion that we amortize is going to be added to the book value or carrying value. So the carrying value is going to go up until it gets to
200,000.
yeah. So when we have a discount, the carrying value of the bond is going to go up. But the premium, on the other hand, if you look in the see, we're getting cash 20,208,530, correct? So every time you amortize a little bit of the premium, you're going to take it out of the carrying value. So the carrying value goes down until you get to
200,000.
yeah. So the carrying value under the discount goes up. Under the premium, the carrying value goes down. And because in either way, we're going toward the 200,000. So you're either going up or you're going down to 200,000. Yeah. Remember, maybe that's going to come in one of the multiple choice questions on the test. Yeah. Remember that. Okay. So let's go back to our example with the discount. How do we do the amortization? We're going to divide the 8,000 by 10. Okay, we're going to divide. Okay, let's do the discount first. Amortizing the discount under straight line. Okay, under straight line method. All right, so we divide the 8,000. Was 8,000 correct?
Yes, sir.
8,000 by 10 periods, because since it's straight line.
Same
and that give us what? $800, correct? So every 6 months we have to amortize 800 out of the 8,000. Okay, so what kind of journal entry we need to do? Now remember, we do that when we pay interest. Remember, there's a bond and we are paying interest every 6 months, correct? So what do we debit? We debit interest expense. For how much interest expense?
800.
No, wait a minute. Wait.
Oh, it would be 8,000.
Let me just see. Debit. Oops. Before we write down the amount, okay, before we write down the amount, we're going to write down the credit. We usually credit cash, correct?
Yes, sir.
Cash. By how much is the cash? Usually. With the original interest payments.
Oh, 800.
The original interest payment, no, not the 800. This is the
Oh, 800.
amortization portion.
So original interest payment be 8,000.
Going back, okay, what was the stated interest rate originally on our example? Was it 9%?
Oh, okay. That's what you're talking about. Yes, sir.
So how much was it?
9%. Oh, I got it.
Is equal to it was a 200,000. It was 7%. Sorry.
Oh.
You go back to the original example.
Oh, I don't think I was here.
Go back to the original example. It was 7%.
Oh.
All right. So it was 200,000 times 7% times 6 over 12 is equal to 7,000. Okay. So the cash is going to be credited for 7,000. All right. Okay. Now, what is the original balance of the discount, unamortized bond discount? The original balance of the unamortized when we first issued, it was a debit balance. So we debited cash and we debited unamortized bond discount and we credited bonds payable. So it has a debit balance. When we amortize it, we credit it.
Okay.
So in addition to the cash, therefore we're going to credit unamortized bond, discount. By how much? We said when we divided it by 10, we came up with 800, correct?
Yes, sir.
800. So let me put that a little bit further. Looks funny. And the interest expense is going to be what? 7,800.
Yes, sir.
Notice it is more than the regular. The regular interest expense was 7,000. And so why it's increased? Why did it increase? because of the discount. So the discount increases our interest expense. So what's the significance of that? Where does the interest expense show? Which statement? Income statement or the balance sheet? Expense now, this one. Income statement. Don't guess.
I wasn't about to
Yeah.
guess. I was just
Income statement.
revenues minus.
Now I get on you, Brother Bailey, because I more than Reverend Darian. Okay, because I mean you are concentrating more than him. He used to stay on the phone all the time.
Now,
You don't stay on the phone yet.
Yeah.
Okay.
Oh yeah, I got.
Yeah, I'm counting on you a lot.
Yes, sir.
So it makes our interest expense higher, and therefore makes our income smaller. So that's the effect of the discount. It makes our interest expense a little bit higher. Okay, so it is a payment. When we say amortization, that means we are paying off that. When we pay interest, we are getting rid of that difference. That was amortization mean. But it's on our own expense. We are increasing our
Paying out of pocket.
yes. Mhm.
Okay.
It's not a payment.
Well, out of
It's
pocket,
reducing your income.
Reducing it.
Yeah, that's the ultimate effect of it. Yeah. Since the straight line method, you do the same journal entry for 10 times. Same journal entry every 6 months. Every 6 months. All right. So there is no need to do that one more time. Period.
Okay.
Okay. But the premium is the one that we need to do updating. Okay, the bond premium, we got to do updating every time you have a new interest expense. Every time you have, this one is a plug figure, it's easy. You just add the interest expense, your cash payment, which is your interest expense, your original interest expense plus the portion that you amortize. That's easy. Then you do the same journal entry. All right, and for a premium, we would have to update the carrying value. You have to update every 6 months. You update the carrying value.
Oh, yeah, okay.
So if you go back to the premium, bond issued at premium, let me find it, discount. Okay, the bond issued at premium. Where, I thought we did the journal entry. Ah, here it is. The carrying value is 20,830. Okay, so the first interest payment is going to be, the interest expense is going to be your carrying value times the market interest rate. That's your expense, not the stated. That's why it's called the effective. Oh, I'm going to the effective interest method. Sorry.
I thought we still on straight
Yeah,
line.
we haven't done the. We're still in the straight line. Okay, even though that's fine, we can do. We're still in the straight line. So the straight line, we go straight. The interest expense is still the same, 7,000.
Okay.
Okay, 7,000. So we're going to say except the difference is in the, instead of debiting the, instead of crediting the unamortized bond discount, we're going to debit the unamortized bond premium, because its original balance is credit. When we amortize it, we have to debit it. Okay, we have to debit it. So if you look at the same example on, let me see if they did that bond. Okay. I think the book did not do an example. So let's do our example on the premium. Okay, the interest expense is still 7,000. Okay? And how much is the premium?
5,030.
The premium is no, 8,530.
Yeah.
So divide 8,000 by 530.
What?
Sorry, 8,530 by 10.
Yeah, 853.
Yeah. 8,530 divided by 10, and that gives us $853. So we have to amortize 853 every 6 months out of the premium. Okay, now remember the carrying value of the premium is going down. Okay, so we go back again here. We're going to debit interest expense, and we're going to credit the cash expense. I'm going to debit now. We always debit interest expense because it is an expense. And then we're going to credit cash. Did we say 7,000?
Yes, sir.
Okay, 7,000. All right. Since the balance, the original balance of the premium is a discount. Is a credit. When we reduce it, we have to debit it. So we're going to debit. Oops. Undo. Let's go back to the next page then. Okay. Debit interest expense and debit unamortized bond premium. How much was that portion?
530.
When you divide the premium by
853.
10,
Yeah, 853.
853. Let me get that back here. All right. So, what's the difference between 7,000 and 853?
6,147.
Huh?
6,147.
6,140. See, notice the interest expense now
Goes down.
is lower. So when we have a premium, the interest expense is going to be a little bit lower. It's a plug figure between the portion of the premium and the cash payment. And the original, see, you are paying $7,000 as interest expense. But how much do you recognize on the income statement? You recognize, yeah, so you save a little bit of interest. So on the discount, your interest, recognize interest is a little bit more. And on the premium, your recognized interest is less than, even though you're paying it, you are paying the whole 7,000, but you only recognize this portion, yeah, on the income statement.
That's cool.
Yeah. Okay. So this, and you do the same journal entry for 10 times. Okay. Now let's go to the effective interest method. All right. This is the straight line method. Okay. Let's go to the effective interest method. method of amortization. Okay, let me make this one bold, and that's already 18. Let's do the discount first. Okay, the discount. How much was the carrying value at the discount date when we first issued it? Go back to it was 192,000. So we're going to say the interest expense is equal to interest expense is equal to the carrying value or the cash value of the bond times, guess which interest? The market rate.
Yeah.
Because it's called the market rate is the effective interest rate. Okay, the market rate is that's why it's called the effective interest method. Okay, effective interest method amortization, because we're using the effective interest rate, which is the market interest rate. In this case, how much was the market interest rate?
It was 12, right?
Was it 12? Oh, the first one. Go back to the example, and it was
12%.
No, it was 8.
Oh, yeah, it did drop to 8.
Yeah,
Okay.
it was 8%.
Fell to 8.
Therefore, it's time half of it,
4.
times 4%, or times 8% times 6 over 12. Okay, you're going to come up with the same results, yeah. So times 0.04 or 0.4%, all right? And what do we get?
The current value is 192,000, right?
Uh-huh. Oh, let me write it down. No, wait a minute. Yes, 192,000. 192,000 times 4%.
7,680.
How much?
7,680.
680. That's our interest expense. So we're going to debit interest expense for 7,680. 7,680, and we're going to credit the amount of cash, which was 7,000, if you remember. Was it?
7,000.
Credit cash 7. Wait a minute. Yeah, 7,000. Sorry. Oh, and also we're going to credit, let me make it a little bit further. Credit unamortized bond discount for how much? How did you figure that out?
Yeah.
You're right, because it has to balance.
Yeah.
See, under the straight line, we divided the whole discount by 10.
Yeah,
Here, we don't divide by 10. It's going to be the difference between your interest expense and your interest payment or cash. Now, the next interest payment, you have to update your
Current value.
carrying value. Remember, we said the carrying value under discount is going up.
Yeah.
So the new carrying value is the new carrying value is going to be your 192,000
Plus
192,000 plus
7,680 or just
680
680? Oh, 680.
plus 680.
Oh yeah, 'cause that's how much.
So which is equal to
192,680.
192,680. So the new interest expense now is going to be the new interest expense is equal to 192,680.
Times 4%.
92,680, yes, times 0.04, which is equal to,
7,707.
how did you,
I already did it.
7,707.
707. It says 0.2, but since it already.
It's okay, we don't, yeah. So the journal entry is going to be, we're going to debit interest expense, debit interest expense for 7,000.
707.
7,708, sorry. And we're going to credit cash
For 7,000.
for 7,000. And the 707 is going to be what?
Amortized by.
Okay, credit unamortized bond discount for 707. Is it going up or down?
Going up
Why?
because you got to get to 200,000.
The carrying value is going up.
So you have to keep multiplying.
Yeah.
4%.
And then you keep, so that's how you do the amortization. You keep doing until the new carrying value is equal to 200,000. Yeah. Okay? So let's look at the premium now. How do we amortize the premium?
It's going to go down.
Amortizing the premium now. Be bold and underlined. Amortizing the premium under the effective method. Somebody's calling me. Under the effective method. Hey, Doc.
I'm looking for you. You still in class?
Yeah, we are on the last portion.
Okay.
Yeah, we are.
Well, I'll talk to you later.
Okay, just a couple of minutes, Doc.
I just want to let you know I got 5 and 1 and 3 and all.
Oh, not bad. Are they cleared?
That's good.
Are they cleared?
Yeah.
Okay.
That's the one's clear.
Oh, okay. Current. They are all current.
That's what. Then you hear me say they clear.
Yeah. Well, ours in our class only 3 clear. The other 3 hasn't cleared yet. Yeah. They no, they're still pre-registered.
Yeah, I got 2. I got
Yeah.
2 that didn't clear. I'm
Let
not
better.
gonna worry
Yeah.
about it.
Let better and
Good,
And
Rich.
Larry,
yeah.
I'm gonna think of Larry. Larry good.
They're good.
They are good.
No, Graham, I was saying he's good.
Yeah, it's good. Yeah, Grim is good. Yeah.
Lead better, good.
But Jimenez also in Florida, he was trying to clear
for
too.
that, you got to come down here and go to because you got to go to the financial aid office and the register.
See, that's where the issue is.
Ah, he's doing it through.
Yeah, you got to go.
phone
You
calls.
got to go to 3 different offices. You got to go to financial aid, registrars, and the business office. Just
Right.
to verify all that.
And that's what messed everything up. And that's how my story.
recorded.
Now, let me say that. That's what messed my students up.
Later, Doc, we'll talk later.
You got two summer twos.
Is
You
that
got number two, numerical number two. I mean, Roman number two. I threw them off.
Okay, let's do the amortizing the premium under the effective method. Same thing, we start with the carrying value. How much was the carrying value under the premium?
208,520, 530.
Interest
Yeah, 208,530.
expense is equal to 208,530.
Yes, sir.
208,530 times 4%. And that gives us what?
8,341.
8,341. All right, so we're going to debit interest expense. Expense. Let's hold on that for just a second. And then we're going to credit. We're going to credit the cash payment for 7,000. Okay. 7,000. Oh, let me make it a little bit further. Okay, how much we are going to amortize? First of all, times 4%. Okay, 8,300. And so the interest expense is. Okay, what is the original balance of the premium? First of all, is it debit or credit balance?
Credit.
Is it? It has a credit balance. So when we amortize it, we debit it. So we're going to debit
8,341.
oh sorry, unamortized. Unamortized bond premium. How much was it? Okay.
8,340.
What's our interest expense? 8,340. So the difference between the 7,000 and
Interest expense.
say it again. The cash is still 7,000, correct?
Yes, sir.
And the interest expense is 803.41. So what's the difference between 7,831?
1,341.
Okay, 1,000.
341.
Okay, let me put this a little bit further. 800 and
You said 8,341 minus
7,000, 1,341.
Yes, sir.
Okay, 1,341. And therefore, the interest expense is going to be the difference between the
208,530 minus 1,341.
now 8,341 minus. Let's see. Let me go back. 20,008 530 times 4%, we get that much. And the unamortized bond premium, the cash is 7,000. Oh, let me see. Okay. Let's see, 8,000. Expense. Interest expense. Are they using a different interest rate for the premium in the book? They're supposed to be using the same interest rate. That's a straight line. Okay, and the premium. Okay, 7,000. Okay. If you look on page 565, then the cash is 7,000. Let me just put that back a little bit. Oops. Undo. Okay, back. Cash is 7,000. 8,003. Let me see, 20,000. 20,000. This number. Okay, what was the carrying value originally?
208,530.
How much?
208,530.
2,8,530 times 4%. So that gives us $821. 800 and.
208,000.
Am I wrong here or what?
208,530.
208,530 times 0.04. 8,341.
Yeah.
8,341, and the difference between that minus 7,000. So we have 1,340. 1,341, and the difference is going to be our interest expense.
Okay.
So which is
5,000.
5,000. Yeah. 5,659. Okay. Oops. Okay. It looks like they used a different interest rate. Well, they used the same one.
What did you get in the book?
Look on the effective interest method. Why do they have 744? And we have more than them. Unamortized bond premium. The interest expense is 8,341 and the cash is 7,000. So
It's saying here they did the semi-annual interest expense at 6% to be recorded.
you know, they have 3%. We have more than them, you see. Look on the bottom here. Times 3%.
Oh, we trying to.
So they're using a different interest rate, looks like.
Yeah.
But that's how you should do it. Okay, they're using the same method, except we have a difference of 1%. 1%, yeah.
Okay.
So the unamortized premium is the difference between the interest expense and. So now you update the carrying value. You're gonna say 208, 530 minus 1004, and then you multiply by the market interest rate, okay, and on and on and on, yeah. Okay, we have one more. Let's stop here for and then we have a couple of more ideas and we'll be done.
Chapter 14.
Yeah, on chapter 14. A couple of more ideas will be done. You know, the one who called me, let me stop. The one who called me, I think Mr. Jimenez. Stop streaming.